Sunlight hits the desk. The ticker hums. Prices flicker on the screen. Small jumps, tiny blips. And yet, nobody's panicking. Weird, right? Because the headlines scream chaos. Talk of ultimatums, oil choke points, threats. But markets, they don't jump at loud noises. Not really. It's what's hiding underneath that matters. The quiet shifts. The subtle moves that almost nobody notices. That's where risk lives. That's where opportunity sneaks in. You look at XRP falling a few cents here, Bitcoin nudging down there, and you think, something's wrong. Maybe it isn't. Maybe the real question is, what's being priced in and what isn't? Everyone expects fear. They expect a big sell-off, a crash, a headline reaction. But look closer. Strength or weakness shows up in small ways first. Patterns in liquidity, timing of trades, bursts of volume that vanish before anyone tweets about it. That's what sets the stage. Markets aren't afraid of news. They're afraid of surprises that matter to capital before the crowd sees it. Over the next few minutes, we're going to peel back the surface. No hype, no screaming predictions, just what actually moved, and why your assumptions about fear might be upside down. It's Sunday, March 22nd, 2026. Clock reads 2:43 a.m. Central Time. On the screen, XRP sits at $1.40. Bitcoin is just above $69,000. Charts flicker quietly, showing a drop that started around 6:45 p.m. the previous evening. The movement is sharp, almost vertical, a sudden shift in price that aligns across multiple crypto assets. Looking closer, both XRP and Bitcoin experienced a synchronized decline over roughly 15 minutes. Trades executed, orders filled, some positions liquidated. Volume spiked noticeably. Futures markets, which reopened Sunday at 5 p.m., show increased activity coinciding with the price movement. Over the past week, XRP has traded between $1.42 and $1.50. Bitcoin has hovered near $70,000. This weekend's shift represents a modest change relative to recent volatility, yet it registers clearly on short-term charts. The decline was simultaneous with public statements from U.S. leadership regarding the Strait of Hormuz, though there is no direct evidence linking the timing of the statements to specific market transactions. Compared to last month, overall market conditions show slight weakening in trading volume during peak hours, with bid-ask spreads widening in some altcoins. Crypto markets had already been adjusting to ongoing geopolitical tension in the Middle East, with minor dips appearing across spot and derivative markets in prior weeks. Institutional markets display parallel reactions. S&P 500 futures fell roughly 5% since early March when the conflict began, tracking broadly with historical responses to similar geopolitical events. Treasury yields and dollar indices show minor shifts, suggesting markets are processing global risk but not in panic mode. No new regulatory announcements occurred over the weekend. Exchanges remain fully operational. No extraordinary technical outages were reported. Market infrastructure appears intact. Summary: XRP and Bitcoin experienced a simultaneous price drop of a few cents/percentage points late Saturday evening. Trading volume spiked, futures reacted. Historical volatility and ongoing geopolitical context provide background. No confirmed manipulations, shutdowns, or technical failures have been identified. Markets continue to operate normally, with short-term price adjustments reflecting evolving conditions. A few cents here, a few $1,000s there. On the surface, it might look like a minor wobble. But the mechanics behind that wobble tell a story about how capital flows and who feels it first. When XRP and Bitcoin dip in tandem, liquidity reacts. Large traders adjust positions, some forced by margin requirements, others voluntarily trimming exposure. This movement ripples into smaller exchanges and less liquid altcoins. Orders fill, stop losses trigger, and within minutes, what started in the top 10 cryptocurrencies spreads further down the chain. Futures contracts amplify this. Overnight, automated systems scan price changes, detecting thresholds for liquidation. In this instance, Approximately $240 million worth of leveraged crypto positions were closed within a 60-minute window. That's not panic. It's the math of contracts meeting conditions. The effect is immediate on price and slightly delayed on market sentiment, as traders notice the shift and adjust accordingly. Outside crypto, commodities are first-order affected. The Strait of Hormuz, a key choke point for global oil transport, is under partial restriction. Roughly 20% of global crude passes through. Any disruption, even temporary, nudges shipping schedules, insurance premiums, and futures pricing. Oil-related equities and ETFs see subtle pressure before indices like the S&P 500 reflect the changes, which usually takes hours or days. Banks and financial intermediaries face second-order effects. Settlement times lengthen. Liquidity demands spike. Credit lines may be tapped faster than normal. For funds with crypto exposure, margin calls or valuation adjustments propagate, influencing broader portfolio allocation decisions. For retail traders, these chain reactions often appear sudden and confusing. A price drop feels immediate, but it is the end of a sequence. Statements and geopolitical events to positioning by institutional traders to automated system responses to liquidity adjustments to wider market perception. Understanding this sequence is key. Even minor moves in headline assets can alter risk appetite across markets. If volatility appears in crypto but not in equities, traders may reallocate. If futures show increased activity but spot markets remain calm, liquidity providers adjust spreads, creating subtle cascading effects in smaller markets. In short, the implications aren't just about a few cents or a single statement. They reveal how interconnected market participants are, how liquidity reacts, and where systemic pressure points exist. First to notice are leveraged positions and derivatives. Second are commodities and correlated assets. Third, broader investor sentiment adjusts. Recognizing the layers helps interpret volatility without assuming panic or irrationality. Go back a few decades. You'll see patterns, not duplicates. In the 1980s, Middle East tensions flared. Oil shipments were disrupted, markets jittered, and within weeks, equities and commodities recalibrated. During the Gulf War in 1990, the initial shock saw S&P futures drop about 10%. But trading resumed normal rhythms within 15 trading days. Bitcoin wasn't around then, of course, but liquidity mechanics, how capital moves, reacts, and finds equilibrium, follow the same logic. From 1939 to today, researchers have cataloged over 30 major geopolitical shocks with market data. Across these, two things emerge repeatedly. First, markets hate uncertainty, not conflict per se. They respond sharply to surprises, then stabilize once risk is understood. Second, recovery often begins before the news cycle declares resolution. Markets digest reality faster than headlines convey it. For crypto, the last 6 months have already baked in some of these geopolitical risks. Price dips in early March reflected initial uncertainty over the Strait of Hormuz and U.S.-Iran tensions. By the time the weekend ultimatum emerged, a portion of the market had already shifted positions, hedged, sold, or adjusted exposure. This is similar to historical pre-positioning in equities and futures markets. Traders act ahead of full information dissemination. What's different this time? Digital assets operate continuously, globally, 24/7. Futures and leveraged positions magnify small moves. Automated systems execute in milliseconds. Unlike equities during past conflicts, crypto liquidity is fragmented across exchanges, wallets, and decentralized finance protocols. This means historical price dips may not map one-to-one, but behavioral patterns of adjustment still apply. History isn't a crystal ball. It doesn't tell you what XRP or Bitcoin will do next, but it does filter emotion. It reminds investors that initial volatility is often front-loaded, that markets tend to overreact to headlines, and that normalization happens faster than most anticipate. Recognizing these patterns can prevent knee-jerk decisions and allow measured interpretation of what's happening in real time. Markets rarely move in straight lines. Every price shift, every geopolitical statement, sets up a web of conditional outcomes. Let's consider 3 possibilities: bull, base, and bear. Bull case: Momentum holds in recovery, accelerates. If trading volumes stabilize and no further disruptions occur in the Strait of Hormuz, risk on sentiment could return quickly. Capital that exited last week may re-enter, chasing green candles. Institutional funds could rebalance allocations toward crypto, especially XRP and Bitcoin, if perceived risk premiums drop. Liquidity would firm, spreads tighten, and minor dips might get absorbed almost immediately. Under this scenario, short-term volatility shrinks, while longer-term accumulation continues. Markets may overshoot on the upside as FOMO compounds, but this relies on geopolitical events remaining contained and, no surprise, operational disruptions in oil or shipping sectors. Base case, stabilization with oscillating volatility. Here, geopolitical tension persists but remains contained. Prices fluctuate within recent ranges. XRP, around $1.35 to $1.50. Bitcoin, $68,000 to $70,000. Leverage-driven liquidations occur sporadically, but are absorbed by broader market depth. Institutional and retail participants adjust positions incrementally. Futures and options show modest increases in implied volatility, reflecting uncertainty rather than panic. Market impact is primarily short-term liquidity and spread adjustments, not structural declines. If this path holds, recovery to previous highs could take weeks rather than days, but the market remains functional. Investors may experience temporary drawdowns, but underlying adoption trends and ecosystem developments, like tokenization projects or payment rail integrations, continue unaffected. Bear case, escalation, or shock. If Iran refuses to accommodate shipping traffic and a military engagement occurs, or if insurance and shipping costs spike unexpectedly, short-term shocks could accelerate. Leveraged positions might cascade, particularly in thinly traded altcoins. Contagion could spread to correlated assets, commodities, ETFs tied to oil, or tech equities sensitive to global liquidity. In this scenario, volatility would spike, spreads widen, and price discovery slows. Market participants may retreat to cash or low-risk instruments temporarily. Recovery would depend on how quickly operational certainty returns, insurance markets adjust, and traders regain confidence in liquidity and execution. Historical analogs suggest rebounds occur eventually, but timing and magnitude are uncertain. Across all scenarios, the conditional structure is critical. Bull requires containment and stabilized sentiment. Base relies on persistence of current trends without escalation. Bear is triggered by operational or geopolitical shocks. By framing outcomes this way, we separate what is likely to happen from what is possible, and can evaluate market behavior without asserting certainty. Professional risk awareness here is about layering probabilities, not betting the farm on one outcome, monitoring indicators that shift conditions from base to bear, and watching for early signs of liquidity stress. Markets respond to perceived risk, not narrative alone, so recognizing these triggers is more actionable than reacting to headlines. First thing I do is check the US dollar index, DXY. It's not flashy, but a stronger dollar tends to pressure crypto assets. Moves of even 0.5% over a day can shift positioning, particularly in leveraged trades. I note whether it's a broad trend or a short-lived spike. That tells me whether markets are reacting to liquidity flows or just headlines. Next, Treasury yields, especially the 2-year and 10-year. They're a pulse on risk appetite. Rising yields can make risk on assets like crypto less attractive temporarily. Falling yields suggest capital may rotate back into alternative stores of value. I'm watching the curve too. Steepening or flattening tells a story about inflation expectations and future central bank actions. Speaking of inflation, CPI and PCE data remain crucial. Even if the market reacts in the short term to geopolitical events, persistent inflation shifts real interest rates and liquidity. That's what ultimately underpins broad appetite for risk-on assets. I track both headline and core figures, plus the month-over-month changes. In crypto specifically, volume and liquidity are my day-to-day radar. Where is the liquidity concentrated? Which exchanges are absorbing trades versus passing them along? Low liquidity can exaggerate price moves. High liquidity may dampen shocks, but reveals where capital is positioned. Finally, I watch open interest and derivative positioning, especially in futures and options. Large concentrations of leveraged positions can be early warning signs of rapid liquidations. If open interest rises alongside a sudden price move, the probability of cascading effects increases. Conversely, declining open interest often signals risk is already partially priced in. Taken together, these indicators provide context beyond what social media or news cycles emphasize. They show where capital is flowing, where stress points exist, and which moves are systemic versus isolated. For professionals, these are the levers you watch. Price itself tells you what happened. These indicators tell you why it happened and what could come next. Markets moved, prices shifted, headlines blared. But the underlying mechanics are unchanged. Liquidity flows, derivative positioning, and capital allocation continue their work behind the scenes. Volatility is part of the process, not a signal to panic. What matters is patience and context. Observe the indicators, understand the sequence of reactions, and separate temporary shocks from structural changes. Geopolitical events influence the chain, but they don't erase fundamentals or long-term trends. This isn't a forecast of a rally or a collapse. It's a way to interpret what's happening, layer probabilities, and identify where risk is concentrated. For those watching markets professionally, clarity comes from consistent observation, not headlines. So, step back, monitor your indicators, and let the data, not the noise, guide your decisions. This isn't investment advice. It's simply how I'm reading the market right now.